Hello everyone, welcome back to All Financial Discussion channel. For this video, I'd like to continue the series of discussion to use another parameters to determine whether this stock is still a good buy or not. So this video, I will concentrate on debt to equity ratio. So I will use these parameters to determine this Singapore Bank DBS is still a good buy or not. So basically this will be the objective of this video. Guys, before I continue, I'd like to urge you guys to help me by like this video. Guys, just give me a few seconds. Help me. Press the like button now. For those who are new to this channel, and if you want to encourage me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. A quick disclaimer. This is not a financial advice. Please conduct your own independent research and consult a professional if needed. Never invest more than you are willing to lose. With this, we are ready to kickstart today's discussion. These are the parameters that I have fully discussed based on my previous discussion. All these parameters actually decide the valuation of the company. These actually determine whether the share price is still a reasonable buy or not. So guys, urge you, if you have other parameters and if you like to suggest to me, please help me to comment so that we can learn as a whole in this learning community. After going through the valuation of the company, so this video, I'm going to concentrate on the financial health of the company. So this video, I will explain how can we actually use this debt to equity ratio to determine whether this stock is still a good buy or not. So basically, what is the definition of this debt to equity ratio? This actually compare the total debt or the total liability to the shareholder equity. So when it is a number, which is over 1, or maybe if you compare as against the industry peer, this number is significantly higher. This can be a potential red flag. So especially in a rising interest rate. So what happened here is basically when you have a lot of debt and with a high interest rate, so your commitment is actually higher, and therefore this can be a potential red flag. Other than debt to equity ratio, there are also various parameters to determine the financial health and the stability of the company. Besides that, we can also concentrate by looking at the profitability of the company and also the potential growth aspect of the company. Let's come to the definition of debt to equity ratio. What is actually this? This is actually a financial leverage metric that actually compare a company's total liability to its shareholder equity. It is used to evaluate how much a company is actually financing its operation through debts versus shareholder fund. This is the equation, as you can see from here. This is actually the debt to equity ratio. You can see that this is the total liability or the total debt over the total shareholder equity. So this total shareholder equity, if let's say the company so-called liquidated, this will be the amount that can so-called can be secured by the shareholder. Let's come to the different definition. So this is actually the total debt or the total liability. So this should include all the short-term and also all the long-term debts and also the obligation. Next will be the shareholder equity. So this is in fact will be equals to the total asset, which means that whatever so-called revenue that you actually generate by the product, by the service, minus away the total liability. So this is also known as the book value of equity. Let's come to the interpretation of debt to equity ratio. So when we actually has a high debt to equity ratio, this is actually undesired. Why? So this simply means that this company actually has a higher reliance on debt financing. So this typically indicate that high financial risk, but possibility higher return on equity if the company earns more on borrowed funds than the cost of debt. So this is quite risky, but later on you will realize that this debt to equity ratio actually depend on different sector. Different sector actually has different value of debt to equity ratio. So therefore, I cannot purely just say that if let's say it's more than one under this high debt to equity ratio, this is undesired. So on my next slide, I will explain. When we have a low debt to equity ratio, this is more reliance on equity financing, generally indicate lower risk but possible lower return on equity. Next, this is what I mentioned. Okay, when they are exactly equals to one, this simply means that the liability actually equals to the equity. Okay, so this is in fact a very balanced financing. So these two, which I have described earlier on. Now let's move on to the different so-called typical debts to equity ratio by industry. Let's focus on technology first. Okay, so for technology, typically they has a very low so-called debt to equity ratio. Why? Because most of the technology they actually don't need a lot of capitals. Okay, so basically where the technologies fund will be basically will be on the IP, will be on the labor, okay, all the intelligent so-called works on the technologies. So therefore, this is more equity financing. Coming to the consumer goods, so they are in between 0.5 to 1.5. Okay, so they reflect high reliance on debts for inventory and operation costs. Just imagine this, you set up a shop to sell something. You definitely need to have your so-called things to sell. So therefore, you actually incur some debts to your supplier that actually supply all this good for you to sell. And also, you probably need to have some form of operation costs. You need to pay a rental, you need to so-called hire some men to help you to look after the store. So typically for consumer good, okay, so the debt to equity is not that high, okay, but you can see that sometimes it can be more than one. Next, on the manufacturing, as you can see that for manufacturing, it is actually higher than the consumer good, okay, because you're going to have a mix of that. Okay, beside okay, the final goods, you also have the raw materials. So therefore, you have this so-called debt in terms of the final goods, okay, which is not sold to anybody yet, and also the raw materials which you obtain from your supplier. Okay, basically also you're going to have some debts in terms of the equipment and the equity. Next on the utilities, okay, so you can see that utilities, they are actually quite high, okay, because they are actually very debt heavy. For example, for utilities, you probably need to maintain the infrastructure. Let's say you are telco, okay, so basically you need to maintain all the base station, okay, but you can see that for this type of business, they actually are very stable cash flow. Last but not least, on banking and financial, okay, so typically the number can be quite high. Okay, in fact, they can be around five. Okay, because debt is actually part of their business model. For example, okay, basically they loan up some money. Okay, so basically this is under their debt. So that's why when you actually use this step to equity ratio, this is very important because this is actually a comparison against okay the same industry rather than different industry. So this is where we can actually apply this debt to equity ratio. Basically, focus on the same industry, compare the two same company in the same industry, and from there you can draw a conclusion which is actually a better buy. Next, I'm going to discuss why we want to use this debt to equity ratio to determine whether this stock is still a good buy or not. In fact, investors widely use this debt to equity ratio in order to judge the company financial issue. First, okay, we come to the risk assessment. So as I mentioned earlier on, investors actually use this to judge the financial condition of the company. Firstly, let's say the company actually has a higher debt and with higher interest obligation. Okay, so then this can actually strain the cash flow, especially when the company has downturn. So another thing is because investor can actually use this debt to equity ratio to gauge the bankruptcy risk. Okay, so basically they can judge whether the possibility of this company will declare bankrupt or not. So this is a very useful tool. Next, on a comparison, I have highlighted early on that most of the time when we actually use this debt to equity ratio, we want to compare within the same industry. Why? Because some industry naturally they actually carry more debts. For example, like bank, for example, like utilities. Okay, so basically this is used to compare the leverage across companies or industry. Some companies, okay, for example, the utilities, the bank, the telecom, they typically have higher debt to equity ratio due to stable cash flow. Next, based on your investment decision. So the lender actually uses to judge the creditworthiness. Okay, so the influence cost of capital affect the valuation model. This in fact can impact the credit rating and also the borrowing terms. Now let's come to the limitation of debts to equity ratio, the accounting difference. So different countries have different standard. For example, the GAAP versus the IFRS. This can affect the liability or the equity classification. Okay, because we have many different ways of standard. Okay, of the accounting to compute the company status. Next, on the market versus the book value, the debt to equity usually use book value of equity, which means that based on historical data, not on current market value. So therefore, a high market value can make leverage appear lower if calculate with market equity. Next, come to the qualitative factors. Okay, so this does not capture the debt terms. Okay, for example, from the equation, you can see that I never consider the interest rate. I never consider the debt matured or the operating context. Coming to the cash reserve. Okay, so a company with high debt but huge cash balance may be less risky. Okay, so basically, this, in fact, you can use this net debt to determine whether this company is still healthy or not. Guys, before I go into the example using this debt to equity ratio to determine this Singapore bank is still a good buy or not, I like to urge you guys to help me by like this video. Guys, just give me a few seconds. Press the like button now. When more you guys actually help me to like this video will have a better chances to reach out to a larger audience. So guys, help me. Press the like button now. If you have learned something from this video and if you want to support me, please consider to subscribe to this channel and turn on your notification bell. Once again, thank you so much for strong support. Let me give you an example how to compute the debt to equity ratio using this Singapore Bank DBS. Okay, for example, for DBS Group Holding, okay, so we can actually see the recent financial data actually shown over here. Okay, so basically, if you look at this link here, okay, you can find all the financial so-called statement on DBS. So from here, you can see that the debt to equity ratio, which is 111%. Okay, so if you turn this all into the ratio, this is actually equals to 1.11 or 111%. Okay, so this is in fact the most current quarterly figure that is available from financial data source. Okay, so that means simply that DBS has about $1.21 of total debts for every $1 of shareholder equity. Okay, so in percentage term, this is 111%, which is normal for a bank given how they fund asset with customer deposits and also the borrowing. So if you want to look at a bigger picture, okay, so other data platform list the most recent annual figure, which is closer to 0.94, okay, which is 94%, depending on the timing and the calculation method. Okay, but the number 1.1 figure is widely cited in updated financial report. Okay, for example, if you want to look at the annual, okay, again, you can look at this link here. So basically, you can see that this is actually the debt to equity ratio for DBS, okay, which is 0.94. Let me do a very quick conclusion, okay, for banks. Okay, so for banks in general, they actually has the higher debt to equity ratio. So this is actually very common, okay, because bank actually operate with large amount of deposits and also the lending. So leverage is part of the business model. So a debts to equity ratio around 1 to 1.5 is typical and often viewed as acceptable for large bank. True exact healthy level vary by local rules and the risk profile. With this, I like to end my discussion. Please help me to like this video and subscribe to this channel. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.